Good morning from London. I'm Anna Edwards alongside Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Chinese stocks continue their fall but regain some losses as Beijing announces the Ministry of Finance will brief on fiscal policy this weekend. Markets await Fed minutes due later today. The US Justice Department weighs breaking up Google, alleging the company is monopolizing the online search market. Google says splitting off Chrome or Android would, quote, break them. Plus, Hurricane Milton tracks towards Florida as a Category 5 storm. Authorities issue evacuation orders with flooding and high winds expected to inflict widespread damage.
So China dangling a carrot at these markets. Will we get more fiscal stimulus at that meeting announcement on Saturday? European futures pointing higher. Keep an eye on the miners. We've seen a bounce in commodities this morning. Brent still below $78 a barrel and the US 10-year yield still hovering above 4% as we look ahead to that US CPI print. The countdown to the opening trade starts right now.
Wednesday the 9th, good morning. Welcome to the show. Monday morning's going to be interesting. We're going to be factoring in this briefing from the Finance Ministry in China. How big a story could that ultimately be? We're going to have to wait and see. But before we get to that, there is so much to think about. We've got Fed minutes today. We've got CPI data to work our way through. And we have the arrival of Hurricane Milton.
Yes, absolutely. And once again, this is Category 5. So yesterday we saw it downgraded to a 4, but it's once again got winds of 165 miles an hour. Of course, coming less than 2 weeks after Hurricane Helene, which, let's not forget, killed at least 230 people. When we focus in on the damage that could be caused here, there's a huge range of estimates, anything from $60 billion up to more than $150 billion. It depends a lot as whether it makes landfall as a 3 or a 4 category and the extent of the storm surge. Catastrophe bonds, which were really popular trade with hedge funds in 2023, if they fail to pay out, that's going to be something we're going to be watching.
Yeah, and I feel like there's always this debate around the ethics of cat bonds and the thresholds for paying out, but this truly is a catastrophe. This could be one of the biggest insurance losses in history. Analysts say you're looking at something worse than Hurricane Ian. Yeah,
it's hitting a major metropolitan area, potentially, and that is the real difference this time round in terms of the impact that it could have. You do wonder as well whether or not there could be an impact on US politics as a result of this, depending on the damage. We are days away now from a US election.
Yeah.
If things go wrong, which we have seen in the past in terms of hurricane reactions, could that feed through back into the politics?
Absolutely. We remember Katrina, and people have already been saying since Helene that perhaps this is something that we're underestimating, the extent to which Americans are already voting, actually, and voting with memories of what Helene did to their environments and their communities.
Be interesting to see how the Nasdaq opens up a little bit later on. We are watching this story surrounding Google keenly. The US apparently is looking at the option of breaking Google up as a result of what the DOJ in the United States argues is uncompetitive behaviour. This is one of a number of cases. But I want to come at this from a different point of view, which is how should shareholders be reacting to this? Google is clearly a highly valued company, and the value of it has increased dramatically over the years. But is Google a conglomerate, or is it not a conglomerate? If it's a conglomerate, is there a discount? I.e., would a breakup, would the sum of the parts be greater individually than the total that we see on the screen in front of you, and that's Alphabet's market cap? Or does the data flow around this business and actually provide a benefit for all of the different parts of the business, and actually you do get a greater than sum of the parts valuation? I don't know, but it's, you could argue it both ways.
Yeah, so I don't know the answer on the sum of the parts calculation, but I suppose conceptually, if you were looking to make more out of the parts, you might want to do it in a way that you chose rather than the way that the DOJ deems necessary, if indeed they do deem necessary, because this is just one of a number of options in a 32-page report that they could come back to.
Yeah, but it's significant. You haven't had an attempt on this scale since Microsoft 20 years ago, but of course that was unsuccessful. Let's see whether they succeed here.
But this is just one of a number of cases. There's another case that is going through, and I think you're going to hear final arguments in November, which relates to the ad market, which again may result in a similar remedy being suggested. Now, as you say, it's not the only remedy being suggested. It is but one. It could allow... another remedy could, for instance, be data sharing.
Yeah. Dan Ives says this is going to spend years in court. So we might sort of, put a pin in this one
the US
and
way.
come back to this story.
But while we wait for that, we have got something more pressing. On Saturday, the announcement of an announcement from China, potentially more fiscal stimulus coming, evidently recognising that they didn't do enough to excite the markets yesterday. So the ball back in the government's court. Two questions, really. Is the government actually willing to do whatever it takes to stimulate the economy? And what does whatever it takes mean? Is that just hitting the GDP target, or is it actually shoring up the property sector as well?
It's interesting to see that this is the Ministry of Finance, though. We had this briefing Monday, and there was a lot of kind of expectation around that, but it wasn't the Ministry of Finance. This is the Ministry of Finance. This is where the fiscal story is going to come from, if it is going to come from anywhere. The market's been waiting for details, and what the market's really been waiting for is money.
Yes.
And this is potentially where that money could come from.
I like the wording of the specific invitation. It says it's an invitation to hear about intensifying the counter-cyclical adjustments of fiscal policy. So there we are. We'll tune in on Saturday for that one. It's interesting to link this a little to what's going on in M&A in the commodities sector, because we've had confirmation this morning that Rio Tinto is going to buy Arcadium, and this is unanimous in terms of support from both sides. They say they've got some regulatory approval as well. But yesterday, the mining sector was the worst performing sector in Europe, and that was all to do with China. And weakness in China and assessing the underlying weakness of the Chinese economy has been just one of the things that weighs on lithium prices. Of course, EV sales has been another. Evie Hambro, when we spoke to him at the beginning of the week, was saying this could be a good time, because of all the weakness in prices, this could be a good time to make deals that have longer-term price recovery in mind. Yeah,
so expected to close mid-2025. Just in terms of the reaction to this fiscal potential announcement from China, stocks paring some of their earlier losses, not all of them. The CSI 300 is still down 3.85%, but commodities getting a bounce.
So commodities are getting a bounce, but to Anna's point, they got battered yesterday. So it is a little bit of recovery maybe was already likely to be something that we were going to be watching for on our screens. Let's talk about what else we're going to be discussing. We're going to be folding some of these stories into our guest conversations. Is the dollar back? We all thought the dollar sell-off would last a little bit longer, but it hasn't. Demand for US dollars, demand for US assets seems to be a big theme once again. Kit Juckes, head of FX strategy at SocGen, is here to talk about that very shortly. At 7:30, we're going to dive into that Chinese consumer story. The data coming out of China from Golden Week actually does seem to signal that actually the consumer has not been on the front foot. The spending has been a little bit muted. Sweta Ramachandran, a fund manager at Artemis, is going to be joining us. She has been in China. We'll get some boots on the ground, kind of, or maybe, should I say, Prada shoes on the ground, experience of what the Chinese consumer story actually looks like. Eric Wittenus, EMEA Investment Strategy Head at JP Morgan Private Bank, is going to be joining us as well. 8:30, Mark Dowding, RBC Blue Bay Fixed Income CIO, is going to be on deck as well. Both Jamie Dimon talking to us and Ray Dalio talking at Greenwich, both making the point you shouldn't be worrying too much about what is happening with the short-term movements in bonds. Are we going to be seeing cuts? Are we not going to be seeing cuts? It's the deficit that's the long-term story that we should be watching out for. OK,
well, we've got plenty to watch out for as well on the data front today. At 12 p.m. London time, we get US mortgage applications, more of a read on the property market there. At 1 p.m. UK time, Mexico and Brazil inflation data drop. Then at 7 p.m. UK time, it is the Fed minutes. The dot plot suggesting not everyone agreed with that jumbo cut, so it'd be interesting to see how much division there was on the FOMC about the economic outlook. And then also today we have Sky News having reported that the UK Chancellor Rachel Reeves will be meeting with bank chiefs from Barclays, HSBC, Lloyds, NatWest and Santander, which is interesting again in the context of our Jamie Dimon interview, given he's been saying the regulators in the UK and the US have made it hard to go public. So what are the banks going to be saying to Rachel Reeves at their little meeting today? Yeah, plenty of interesting comments, no doubt, at that one. The UK story is really interesting. Jamie Dimon was quite positive about the growth agenda, but yes, critical on the IPO side of things, both sides of the Atlantic saying it needs to be easier to do that. In terms of, I mean, the Fed minutes are going to be a focus for us later on as well, aren't they? And the extent to which Jerome Powell had to corral the others into 50 basis points or not is going to be one of the key questions we're looking to get a bit of clarity on. It all changed incredibly quickly into that meeting, didn't it? We got the journal pieces, we got the various guides coming through in a sort of tacit way, telling us that maybe 50 was the way to go. How is it working behind the scenes? What kind of a debate, as you say, was there going into that meeting? It's going to be fascinating to see what that delivers. Also, this coming ahead of CPI
tomorrow, and then PPI on Friday. What else you need to know this Wednesday morning? Let me run you through some of the other details. The Pentagon says a visit to the United States by the Israeli Defense Minister has been postponed. Bloomberg has learnt it's because of last-minute objections from Prime Minister Benjamin Netanyahu. Axios is reporting that President Biden is due to speak with Netanyahu later today. Brazil's Supreme Court has authorized the reopening of social media platform X after CEO Elon Musk complied with its demands. Those included removing some user accounts and appointing a legal representative in the country. The order ends a feud between Musk and Brazil's Supreme Court, which has gone on for a month. A feud between Musk and a Supreme Court. Anyway, let's wrap this up. Talks between Boeing and its largest union have collapsed for a third time. Workers have been on strike for more pay over the last month. It's now nearly a month, with Boeing initially offering a 30% wage increase. The plane maker has now withdrawn that proposal. The strike is costing the firm, we think, we're kind of trying to work it out, but 100 million per day. You've also got this ratings downgrade threat now, which is significant because Boeing is burning through cash aggressively at the moment. And the ratings companies are basically saying we may need to start to downgrade you. That would make that position even worse because the cost of capital would go up.
Absolutely. So it doesn't help in the short term, does it? It makes things harder. I mean, and it's not just any old downgrade. This is S&P considering a downgrade to junk. So we're watching that very carefully. We know that they're considering stock issuance, but you get a sense that maybe they need to know the size of the hole they're trying to fill before they go to the markets and see if they can raise any more capital.
Yeah, I mean, the way you paint it is like it's swirling the drain. You know, you've got the pandemic, the manufacturing problems, the crashes, the strike, the downgrade potentially. Where is this guy? Like, where is it on the trajectory?
In terms of the whole process, there is an argument that says they need to get this strike over and done with really quickly. They are burning cash aggressively. Boeing gets paid when it delivers aeroplanes. We saw the delivery numbers last night. They weren't as bad as many had feared. Airbus is going to be posting its numbers a little bit later on today. Now, but Airbus has got its own problems to deal with in terms of the supply chain, but nothing like what we're seeing with Boeing. Boeing needs to put itself... as you say, Boeing needs to get itself in a position where it can understand what the dynamics look like going forward. Then I think it can address the issue of how much capital it's going to have to raise. But the capital raise, many people now believe, is coming. They've appointed representatives to try and get that done. But they need clarity.
Yeah.
But that's within their own purview. They can get that done, that you could argue, by ending this strike. OK,
lots to talk about on the corporate news front then and elsewhere. Coming up on the programme, Kering has named Stefano Cantino as the new Gucci CEO to lead a turnaround at the French luxury group's biggest label. We'll bring you more details later in the show. Plus, JP Morgan CEO Jamie Dimon says regulators in the US and UK need to make it easier for companies to go public. We'll bring you more from that exclusive interview throughout the programme. Up next, we'll be joined by Kit Juckes, head of FX strategy at Societe Generale. If you have any questions, if you want to get in touch, please do send us a message. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
43 minutes to the start of trading here in Europe. What are we looking at? A positive picture. London looks like it might bounce a little bit more than most. Maybe the reason for that is that we are seeing commodities ticking up a little bit. We are now looking forward to a Saturday briefing by the Ministry of Finance in China. Monday morning could be fun as a result of that. But before we get to all of that, of course, we've got to get through Fed minutes out a little bit later on today. US CPI, US PPI data. We're watching as well what is happening with the ECB. Plenty of commentary around what is being potentially plotted in Frankfurt. All of this comes together in a conversation that we had, or Lisa Abramowitz had, with the JP Morgan CEO. He, of course, is Jamie Dimon, speaking exclusively to Bloomberg. He's been voicing his concern about the US deficit, warning that it will contribute towards higher long-term inflation and rates.
Oh, actually, I mean, you got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, and particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2-3 years, will be inflationary. Those will hit later. They should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen. I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I mean, I think we overreact sometimes to volatile markets, but I do think they'll happen again.
David Dimon speaking exclusively to Bloomberg's Lisa Abramowitz at JP Morgan's tech conference. Tech conference equals T-shirt? He wears it well.
Apparently so.
Yes, he looks good. He looks good. Let's talk more about this. Kit Juckes sitting around the table with us this morning, head of FX strategy at SocGen. JP's worried about the deficit. He's worried about kind of the longer-term picture. He thinks rates are going to be higher. In the meantime, the dollar is going up again, which is a little surprising given what is happening. Do you have a logical explanation?
Well, yes, to the extent that there was never any doubt that, the reason that the U.S. has a net investment deficit of $23 trillion is because it's by far the best place for us to invest our money long term. As rates started to fall, as the economy slowed, you'd have thought the case for hedging a hunk of that was pretty powerful. What we saw in the first case, of course, was that the yen carry trade come off, and then the U.S. economy shows some weak data and people get out. But they don't have anywhere else to go, so that much I understood.
Are we also convinced that the U.S. economy is slowing?
Yes, slowing slowly. I mean, at the margin. I mean, it's
the second derivative is important here.
I think 2 weeks ago, I wrote that I thought it was the most gossamer soft landing imaginable so far. We're one payroll number of wow, maybe this is flatlining at a slow rate, but let's call it. Let's call it not. You couldn't forecast a recession on current data as a near-term risk in a kind of 6-month view. So it's doing whatever that is.
Okay.
We call
don't know
that.
how to describe that yet.
We call it a gossamer soft landing. Is quite good and works it for me still. So that's fine.
Okay.
Or a no landing.
Well, if no landing is not a recession, that's fine. But if no landing is we're not kind of getting down to the ground. It's sort of semantics.
We're still in the air.
Okay, still in the air.
Yes.
And so where does that? So how much conviction do you have that the Fed is cutting rates from here? Kit?
Trying to get rates back to some kind of neutral level, I have a lot of conviction.
Yes.
I just don't think there's I think that they're watching the data as much as us. I think that they'll go 25 in November.
Yes.
And I think they'll probably go 25 in December.
Yes.
I think you could miss one of those from where we are now if you want, but they think the level of rates is higher than it needs to be. So do it now because there are lags in the thing. But don't, they're probably still happy that they got a strong start to it, but they're not going to be fussed about that. I think that the debate will be one about do you need to get rates back to where you think is offers neutral with this economy? Do you need to get significantly lower than that? And I suppose if I were on the FOMC, I'd say no. Look, this economy looks like it needs neutral rates.
Right. And so does that mean we don't need any further cracks in the labour market, or the labour market situation doesn't need to deteriorate much from here to justify the path that you described down to neutral?
Yeah. If you're going to generate employment growth at a pace that kind of keeps the thing ticking along, you're okay. You'd be bothered if you started tightening the labour market again. The unemployment rate was going to be going down, and you would be worried about wage increases coming back and saying, shoot, this is a very confusing cycle. I think that's probably, for the Fed, that's probably as far as it goes.
So Fed minutes tonight, CPI tomorrow, but then the other exciting thing that we're told to expect is potentially this other China stimulus that comes on Saturday, at least an announcement. If you get that, maybe more flows into China, how much faith do you have that they'll actually do whatever it takes? Where does it leave the dollar?
Well, where it leaves the dollar, I still think, separate to all of those, I still think the problem with the dollar is so much money has gone in that some of it ought to come out or ought to be hedged. In 1980-85, the dollar went up much more than it has in any other cycle. It went all the way back without a recession because of this snowball effect of people saying, wow, it's really expensive. In real terms, the thing does mean revert. It's not the equity market. And so people got out, and then that can have a snowball effect. You remember in 2001, 2005, it gave up all of what it had got from 95. So I'd always thought that it's hard to stop it dismantling. What we see today, Japanese investors buying treasuries. We see options traders buying euro puts, sterling puts, because they're worried about the downside. So you look at that and you think, wow. I mean, we are just very different kind of mindset of people sitting there thinking, I don't want to sell my dollars, but they're very exposed to a very expensive currency, the rest of the world. That's the dilemma. You're running a currency risk if you do this. Now, I mean, in a sense, it's not a bad thing if the Chinese come in with more stimulus, because China just having an export-driven economic model with weak domestic demand is politically dreadful for the world and is economically dreadful for the Chinese population. So I'm all for it.
Kit, the last time I spoke to you, you were telling off Labour ministers for warning about a run on the pound if they didn't cut the winter fuel allowance for pensioners. We've got this budget as well coming up in the UK on October the 30th, and I just wonder whether you reckon that the Chancellor, Rachel Reeves, and her team have regained economic credibility since then with all the doom and gloom.
I will point to those growth of puts in sterling in the in the futures market and say, again, you can see from last week, sterling, when it goes down at the moment, it goes down quite fast. The market's long sterling in many ways because, if you were selling dollars and saying, well, where do I want my money, the euro wasn't jumping out at anybody as an alternative. So sterling benefited because we're slower to cut rates. I think, I think the markets are nervous because it's quite high by recent terms, and they're nervous because they're not sure about the politics. But to come back to Liz Truss, whatever she does, really, you have to be able to make sure that it sounds thought about and doesn't sound like something you kind of dreamt up on the back of an envelope in a pub last night and thought was or was the product of some, I don't know, sort of student, perhaps alcohol-related brainstorm. So it's got to be it's got to be part of a vision for how we get this economy growing again. That's the part of
many good ideas have been thought up in pubs, but maybe that wasn't one of them. The euro, what are the chances that actually the ECB is going to have to up it significantly in terms of the cuts that it delivers? The language is changing. It feels like it's changing, becoming a little more dovish, even from the hawks. And I'm wondering, do we need to put a 50 on the table? Do we need to think about kind of how quickly the sequential cuts come through and what that ultimately does to the euro?
The ECB's inflation preoccupation, which is it's got a single mandate.
Yeah.
You and I will have talked about this in 2006, 7, 8, at the time when they were hiking rates into the teeth of a storm. I wish they would not do that again, and would move faster.
Trichet 2.0.
Yeah, we would like that.
Yeah. no Trichet 2.0. Yes. Don't hike into.
So they're not going to hike, but
precisely. But they need to be cutting faster.
But they do, but they won't. So what they will do eventually is cut more eventually.
We'll see.
I mean, I'd love them to cut faster.
Okay. On that note, we will leave it. Kit Juckes, Head of FX Strategy at SocGen, thank you very much indeed. Coming up, we're going to speak to Sweta Ramachandran, Fund Manager at Artemis, her take on the Chinese consumer. She's got on-the-ground experience. She's been there for the last few days. That conversation next. This is Bloomberg. 29 minutes and 52 seconds away from the opening trade here in Europe. It looks as if we are going to be seeing a slightly more positive session. London looks like it's going to bounce a little bit more. Commodities may be driving London a little bit higher, but there's plenty of risk out there for this market right now. Yeah, there is plenty of risk. Let's have a quick look at futures then and see where we are in terms of equities. The handover from the United States was broadly positive, and some of the tech stocks doing well. We have the Google news, though, to factor in today, so the futures picture looks a little more negative stateside. E-minis down 0.25%. Nasdaq futures down by 0.4%. Interesting to focus on the bond market. We're waiting for Fed minutes later on today, and that will maybe tell us a little bit about how much consensus there was around the scale of the 50 basis point cut.
Here, closer to home, we have, of course, bond markets focused on what's going on in France. Politically, the French government surviving a leftist alliance no confidence vote. The role of the right here, crucial, as we've said many times.
Yep.
They have the power to bring this down if they want to. And it
the
seems
RN
at the moment they are minded not to.
Well, precisely, at the moment. That's the critical thing. And we have a budget coming up tomorrow, which is going to be really interesting and really crucial in terms of what the fiscal story is going to look like going forward, what the deficit story is going to look like. So, yes, the confidence vote has been survived. In theory, that's a big sort of kind of vote of confidence in this government. You've passed it. Go forward, deliver a budget, then let's see what happens, seems to be the narrative.
Yeah, let's see where the spending cuts and tax hikes fall and whether that hampers growth and whether it's a slow agony, as Draghi's warned.
Yeah, whether it's something that bond markets can tolerate, whatever the balance is. So we'll park the French story and focus on the fiscal side of the Chinese story, because Chinese stocks have recouped some early losses after authorities announced a briefing due on Saturday. So this is coming up this Saturday. It's a briefing about fiscal measures. For more on China and the read across to Europe, we're joined now by Sweta Ramachandran, fund manager at Artemis. Sweta, so nice to have you with us. We want to tap into your experience. I mean, clearly you cover a lot of different sectors, but you have a great deal of experience in the luxury space. And I know you've been in China really recently and talking to clients and talking to investors there. So really interesting to get your take. I wonder, big picture, how you weigh up what's happened over the last couple of months and how material it will turn out to be. When it's in the rearview mirror, how will we look back on late September, early October on the China narrative? Will we think that this is a Draghi moment?
I think there's definitely an element of sort of game-changing policy about this from what we have seen from the Chinese authorities over the last 18 months or so. They're very well aware that consumer confidence is at record lows. The property market needs to be stabilized before consumers can feel confident again. And I think this concerted, targeted series of measures that we saw starting on the 24th of September have gone a long way to alleviating the market as well as consumer nerves that this is something that is more durable and sustainable in terms of policy follow through rather than sort of the drip feed one-off measures that we have seen until now, which have failed to provoke a meaningful response, which would be a reacceleration in growth momentum that China so desperately needs. So I think even their announcement today, based on the market's disappointment that the NDRC announcement yesterday did not bring about some big bazooka fiscal policy, is testament to the fact that they are listening, they are aware of what is needed, and that they are prepared to follow through with what was already announced.
And so, Sweta, how will that translate then into demand for European consumer goods, do you think?
So I don't think that it will be necessarily immediate that we see an uplift in the fortunes of many of these companies. And certainly, you know, the Chinese consumer is evolving quite quickly. Preferences are shifting rapidly. That said, I think when you're in the middle of a cyclical downturn, there has been a temptation to superimpose a sort of a structural narrative, which simply isn't the case. We noted, for example, you know, from our travel to a tier 2 city just 100 kilometers away from Shanghai, a city called Suzhou, which actually has recently been promoted to tier 1 status, there is a luxury mall with a queue outside the Hermes store. So this isn't the case that the consumer is universally sort of depressed and unwilling and unable to spend. But of course, household deposits are at record highs, savings rates are enormously high, and to unleash those would require a revival of animal spirits, which these announcements would go some way towards doing, and to restoring these companies' pathway to growth in coming years, if not necessarily immediately, although even there, the Golden Week data points perhaps weren't as bad as expected in terms of travel, in terms of Macau visitations. So it's possible that there's a very early tentative, positive surprise. But I think for something more lasting, we need to give this some time.
But I wonder, can you talk more about how those consumer preferences are changing on the ground in China? Because you've seen Kering changing the Gucci CEO, but will it actually matter if you've got Chinese consumers preferring now local brands?
So I think that local brand preference is quite well entrenched in categories such as sportswear, such as mass market cosmetics. In high-end luxury, there is really not anyone, doing this, a local brand doing this at scale. So the barriers to entry and the moat around these European brands still remains quite intact. Their desirability remains high among consumers. I mean, what's really emerging is this extreme polarization where Chinese consumers are looking for brands that are offering true value, which isn't the same thing as price. So higher priced brands perversely are doing quite well because they're seen as offering sort of lasting value, in some cases even a sort of a resale floor value, whereas brands that have either missed the mark in terms of creative design or have perhaps priced themselves too excessively and pushed out that aspirational consumer are really kind of reaping the consequences of that now.
Yeah, I do kind of wonder whether Gucci's going to get a new creative director as well as a CEO. That's something that usually happens. But in terms of the tariff picture as well, Sweater, yesterday you saw brandy and car stocks suffering on the announcement of more tariffs investigations. Do you expect that luxury is going to take a hit too from tariffs? How are you interpreting the China tariff strategy?
The difference between luxury and cognac is that cognac is consumed at home and bought at home. So it's easy in a sense to target it through tariffs because you are directly targeting domestic consumption, whereas luxury is substitutable in the sense that if prices in China go up too much, the Chinese consumer substitutes by traveling abroad or perhaps by having the item bought for them abroad through the Daigou parallel trade business. So that makes it trickier for the government to capture that incremental the tax revenue that the tariffs would impose on those categories. So I think it would be a little more difficult to impose on luxury. Certainly, we heard nothing on the ground that suggested that that is imminent. The cognac tariffs appear to be quite targeted. In some sense, perhaps a retaliation for the EV investigation that the EU is conducting on Chinese car makers.
Sweater, good morning. It's Guy. Lizzie's already hinted at it. New boss coming through at Gucci, coming out of LVMH, Stefano Cantino. What does that mean for that business? Is this the change that business has been needing, waiting for? What do you think the implications are?
Yeah, I mean, certainly he's a very well-respected manager and will take over in 2025. The current CEO is always regarded as an interim CEO after the departure of the prior one. The issues at Gucci, I mean, certainly, a good CEO can go some ways towards solving them. But perhaps the most urgent requirement is that restoration of top-line momentum from the creative output of the current designer really resonating with consumers. The evidence of that is scant primarily because they're rolling out his output in a phased manner. So what you see in stores today isn't entirely the creation of the current designer. So, I guess a new CEO could put in place better merchandising policies. Ultimately, the consumer will decide. The consumer is in a mood right now to gravitate towards really between value on the one end or the very high end at the upper end. So that sort of mid-end, even within luxury, is getting quite squeezed.
New creative director? Would that be a logical thing to do right now?
I wonder if that might be a bit disruptive given the changes that have already occurred. And sometimes you do need to give a designer some time to breathe before their designs really start to resonate with the public. And perhaps measuring his success in the context of a market that's already quite tepid may not be, the wisest thing to do in hindsight.
Sweater, how much more do we see in terms of the retaliation? We followed the European story around cars and tariffs, and Lizzie was asking you about this a little earlier. And then we see the retaliation coming into other sectors. So, for example, cognac was mentioned some months ago, and we got some confirmation around that. And there's more talk about cars. How much further do we have to run on this? How much more amped up retaliation should we expect to see from China? Or are we done? Do we have the scale of it now?
I do believe we're probably at peak retaliation now, and I wonder if a lot also depends on the outcome of the U.S. election, where certainly one of the candidates has promised sort of 60% blanket tariffs on Chinese imports, which would be quite detrimental to China's prospects. And so I think there's a bit of a wait and see here. But certainly from China's side, I think they probably, realize that imposing tariffs into this kind of tit-for-tat war is not entirely helpful to them achieving their own targets of generating 5% or close to 5% growth in the medium term.
Sweater, thank you. Thanks for your time. Sweater Ramachandran, fund manager at Artemis, just back from her trip to China and with some excellent insights for us on the Chinese consumer. Coming up, we'll pick up on a story we were just discussing there. Kering names a new Gucci CEO. We'll bring you more on that and the rest of the stocks that we're watching today. This is Bloomberg. Welcome back to the programme, everybody. This is the opening trade. We still have 17 minutes until we start trading here in Europe. The picture looks quite mixed, actually, in terms of the stock market expectations for this morning. US futures pointing a little bit lower, weighing up the Google story, waiting for Fed minutes, digesting the news flow out of China, news of a fiscal meeting taking place this weekend, turning some of the negativity around in China. More on that in a moment. But let's focus stateside on what's going on in Florida, because Hurricane Milton has regained its Category 5 strength, with residents fleeing the coastline ahead of its expected overnight landfall. President Biden warned the hurricane is likely to have a severe impact.
The current path of the storm is expected to Tampa Bay area and cut directly across the state, east to west, all the way across the state, with the potential for this storm to both enter Florida as a hurricane and leave Florida as a hurricane on the Atlantic coast. This could be the worst storm hit Florida in over a century. And God willing, it won't be, but that's what it's looking like right now.
Let's bring in our weather reporter, Mary Hoy, who can bring us up to date on what to expect here. Mary, good morning from London. So what are forecasters saying about Milton's expected strength then when it comes ashore? Because we know it was Cat 5, then it went down to 4, it's back up at a 5, but it's still an open question what strength it is when it makes landfall.
Right now, the storm is churning about 360 miles off of southwest of Tampa. And yes, as you mentioned, intensity will fluctuate right until it makes landfall. So as we've seen, maximum wind speeds of the storm have gone up and down a little bit, as has the pressure at the center of the storm, which is another indication of how strong the storm is. Another thing we want to pay attention to is the size of the storm. So exactly how far winds, tropical storm force and also hurricane storm force winds extend outwards. And forecasters are saying that actually that the size of the storm, even though it's relatively compact compared to Helene from last month, that the size of the storm will actually increase considerably as it eventually makes landfall and then moves across Florida. So what that means is that the area that will be affected by these damaging winds will increase and grow.
Yeah, so where exactly is Milton going to make landfall, Mary? Where are we expecting? I know Disney World's shut and JP Morgan's got its office there in Tampa. What are we expecting to get hit?
That's right, yeah, it's headed towards Tampa, but right now, even less than 24 hours away from landfall, set for later today, local time in Florida. The forecasters still can't say for sure where exactly it will hit. The storm can do different things between now and then. It can stall, loop, wobble a bit. So it's hard to say exactly, even forecasters saying that their predictions can be as much as 70 miles off right up until it comes ashore. So that's hard to say, to pinpoint with certainty, but what we do know is that wherever it hits, there will be a large area that will be affected by a damaging storm surge, that this will be one of the most destructive storms the west coast of Florida will see, and that heavy rains and damaging winds will occur kind of far beyond the forecast cone of Milton.
Mary, thank you very much indeed for the update. I guess we'll know the answer this time tomorrow. We probably expect that it will have made landfall by this time tomorrow, and we'll bring you all the pictures and the impact that it's had at that point tomorrow. This could have a meaningful impact on a number of different stories in the United States, including the election, which is only days away now. Mary Hoy, thanks for joining us on the story out of Florida. Let's talk about the market in China right now. Our executive editor for Markets Live, Mark Cudmore, joining us. Mark, are you allowed to leave your desk? Because it's a fairly whippy session today.
Yeah, luckily, Guy, I don't really do any of the real work, but my team isn't allowed to leave the desk at all. But no, it is absolutely crazy. Every time I step off to do a TV hit like this, the market might be several % difference by the time I come back. It makes it pretty hard to keep track of things. I think what's really important in the development today is that, you know, we talked yesterday about how everyone expected the National Development and Reform Commission to announce a massive stimulus package, even though it's not their mandate. And there's big disappointment in the market that this commission that doesn't announce stimulus hadn't announced stimulus. Well, the Finance Ministry now has a briefing on Saturday, and they are the group that is responsible for stimulus. So maybe we might get something there. I continue to think that some of the numbers that were bandied about during the holidays are absolutely crazy. Things like 10 trillion yuan at the upper end of the range. I don't think it'll be anything major like that. I think it'll be small steps. I don't think they want to fuel another major bubble. They want to provide enough stimulus to make sure that they ease the impact of the measures, the major amount of measures, the suite of measures that were announced pre-holiday. I think that overall, the more bullish backdrop for China and Hong Kong absolutely remains compared to where we were a month ago.
OK, and what does the price action to date, I mean, maybe it's difficult to read into the price action today, as you say, as it's been so there's so much volatility. But the fact that we paired some of the losses, but now we're back to intensifying those losses on Chinese stocks after we got that news of the intensifying counter-cyclical adjustment of fiscal policy meeting that is set to take place on Saturday. That did seem to calm things for a while, but not for long.
It really depends on your time span here. I think short term, the price action's pretty terrible. It doesn't seem to me that we've necessarily bottomed out in this in correction. But it's important to think that on a monthly basis, look, Chinese stock markets are still up 25% from where they were a month ago. That's quite significant gains. And I think that bulls have the stronger hands. People who have heard the message from the Chinese government that they're going to fix this, they will fix this, they have many tools to fix this, they're the ones who are in the stronger hands in the driving seat here. That doesn't necessarily... I don't know where the next 5% is. I have no idea. And you know what? If you made me choose, I'd probably say we've still got another 5% of downside. I think stocks will be higher a few months from now. I think that overall we've seen a turning point in the China story, and that's the more important one, even though the very short-term price action is negative.
OK, well, we'll have to wait for the price action off the back of that announcement on Saturday. But in the meantime, we've got Fed minutes coming tonight. You're looking for surprises, Mark?
Do you know what? I think we've already moved on from the Fed minutes to some extent because of the jobs report last week. I've heard various arguments either way on whether they'll be hawkish or dovish. I think that whatever happens, they'll have a little bit of an impact, but they won't really kind of change the narrative. Perhaps the more sensitive side would be if they were hawkish. You've got to remember that yields were only at those lows because the Fed had cut by 50 basis points. But now that we've had that jobs report, I'm expecting that overall yields have upward potential from here.
All right, Mark Cudmore, our Markets Live Executive Editor, we thank you. And do remember, you can get up-to-date analysis and insight from Mark and his team, who do all the work, by going to MLIV Go on your terminal. Let's get over to Joe Easton now with our stocks to watch this morning. Joe.
Morning, Lizzie. So Continental is in focus once again today after the auto parts maker last night held a call with analysts to discuss their earnings outlook. Now, we are getting some reaction from the analyst notes today over at Bernstein. They're writing that it is a hopeful message from Continental in terms of what was said on the call, because although volumes were down sharply, they're down by no worse than expected, according to the take there. So we are thinking there might be a bit of a relief in this stock. We can see it's on a bit of a terrible run, trading at around 78 euros at the start of the year, now down to around 56. So really does need a bit of a relief given the issues we've seen in terms of a recent profit warning and parts problems. Now, we do have 13 buys. Potentially this will help some of those bulls reiterate their position on Conti today. Then we're also looking at Kering, a new leader over at Gucci, looking to potentially turn the brand around. Stefano Cantino joining as CEO in January. He is currently the deputy CEO, comes from 5 years' experience over at LVMH, the big rival, and is known for his minimalist aesthetic, according to our reporting. But in terms of the stock, it's another one that is on a really bad run, down 63% over a 3-year period. Now, we did, of course, see big moves in luxury yesterday, massive declines, but I would note that Asian luxury stocks are lower once again in the second day of declines with some of those issues that Mark was discussing around the Asian markets. There's Prada, down another 3% in Hong Kong today. Then we're looking at the suppliers to Boeing on news that the strike is continuing over on the US West Coast. Now, talks breaking down as they look to broker a deal on pay with the union. So the ones to look, Airbus, the big rival, potentially this would be positive for that company given the competition there. Meanwhile, the suppliers, Safran and Signa, Safran in France, Signa in the UK, two of the most exposed. Potentially this could be negative for those. And also Ryanair air, with O'Leary continuing to complain about a lack of new Boeing planes. This could potentially be a negative for some of their customers. Then finally, some interesting analyst ratings. This one catching my eye. BP downgraded Alexane due to oversupply in the oil market. Meanwhile, Delivery Hero gets a new buy at Stifel, and WPP, the ad firm, is on a positive catalyst watch at Citi, reiterating a buy on the UK stock.
Thank you very much. Thanks to Joe Easton, our equities reporter. All of this weakness in China and then any spillover into commodities is really interesting when you think about M&A. We've had confirmation this morning of Rio Tinto and what they're planning to do on the lithium side. And then we get this other story, Varta, which is an electronics components business, pretty small, but Porsche is investing in their lithium business, and that could send that stock popping at the open.
It's interesting that Porsche's making that move where elsewhere in Europe, we're struggling to get forward momentum in the battery business, which is so crucial to the EV story. But Porsche clearly making that decision to go ahead with that. That stock called up sharply. Rio Tinto, it's going to be interesting to see how that one reacts to this news. The early indications look like it's going to be negative, but you do have the China story to fold into it as well this morning, with a better metals picture emerging as we look forward to Saturday. Anyway, the market open is next. This is Bloomberg. Wednesday morning, good morning. Let's talk about how these markets here in Europe are going to be opening. You've got to think about what's happening in China. You've got to think about what's happening in the United States. Let's start off with yesterday and kind of at least put that into the picture that we're looking at this morning. The white line is Europe. We rallied throughout most of the session. Little fade as we come through into the close, but then the US rallies a little bit further. So there's a little bit of upside in there. But do we need to fold a number of negatives into the US session, particularly this Google story, which may weigh on particularly NASDAQ futures? The talk of a breakup, maybe something that the market doesn't like to hear, Lizzie. But broadly, it looks like a positive picture coming out of the yesterday's session into today's session.
Yeah, the idea that the Justice Department might break up Google's monopoly, weighing on NASDAQ futures this morning, lower 0.3%. Looks a bit brighter in the European session. Eurostoxx 50 futures flat to the upside, and especially brighter for London futures. This because the miners might get a boost from the announcement that we're going to get from China on the fiscal side on Saturday, Anna.
Yeah, we'll look for that boost. That's certainly after the sell-off we saw in the mining sector yesterday. Let's focus in on some individual stocks and some sectors in focus. Then we will certainly be looking for movement in Continental. They've given us some improved profit guidance overnight, and this relates to the autos unit, which is the part of the business that we've been talking about, whether they will sell off. So that could be of interest to investors. Boeing, will there be read across from the fact that we've seen for a third time a collapse in talks to try and end the strike taking place at Boeing? How does that read across, that trouble at Boeing, read across into Airbus, if at all? We're watching Kering as well, of course. Gucci is getting a new CEO, and so we'll watch that management change and see what impact that has on the luxury sector. Another one, of course, the subject of big global Chinese forces of late.
Airbus numbers out a little bit later on the delivery front. Right, here we go. It is time for the opening trade this Wednesday morning. Let's take a look at exactly how Europe is opening and figure out exactly where we go from here, or at least try and get an idea. So the London market floating in and out of positive and negative territory. The expectation is it goes north. The reason for that is that we are likely to see maybe a positive picture for the miners, for the commodity stocks, where we didn't see that yesterday. So that should be a positive. It's taking a little while to get going, though, isn't it? Stock 600 is up by just 0.3%. The market feels like it's struggling for a sense of direction. The IBEX is a little soft, actually, at the moment. Here we go. The London market gaining a little bit of steam now, maybe. The CAC 40 is fairly flat. The luxury story absolutely front and centre there. Let's see how Kering trades on the back of the news that we have seen there too. We'll wait for the DAX. It always is something of a laggard. And in the meantime, I think we should probably talk about what's going on with the sector story. Lizzie, you've got that.
Let's break it down by sector. So about roughly half of sectors more than in positive territory this morning. Media leading the gains, higher 0.6%. Just behind it, retail, higher 0.4%. But bottom of the basket, you've got energy, lower 0.5%. Banks behind that, lower 0.3%. You mentioned Kering, the new CEO. Those shares up more than 0.6% this morning. So traders designers welcoming the new Gucci CEO.
Yeah, things look a lot more normal, don't they, in terms of the size of the moves that we're seeing today. So, yes, we're seeing some of those luxury names moving a little higher. Kering is, as you say, higher 0.8%, 0.2% higher for LVMH. So we do see some upside at sort of normal in scale as opposed to the really outsized moves that we'd seen on both Monday and then Tuesday. So that's the luxury space. In terms of the other sectors in focus, energy, I notice, is down by 0.4%. We're actually fairly flat to positive on the oil price this morning. 77.61 is where we trade there. Waiting for an opening price on Continental, waiting for VAT, a very small stock, but really interesting lithium story, waiting for that to open. Volvo Cars, just down 0.7% on the back of some management changes there.
Yeah, and as the hurricane news continues, Swiss Re lower 0.3% as we wait for the landfall of Milton as well. But, yeah, looking to luxury, LVMH higher 0.1%. Burberry 0.4%. But the miners as well getting a boost. So the China news does seem to be filtering through happily into these European markets.
It's interesting what's giving London a lift, though, this morning. It's not what you would have thought, which would be the miners. Yes, they're up, but it's AstraZeneca and Unilever, both two stocks that are giving significant points to the upside at the moment. Glencore is up quite nicely, but it's not. The miners are up, but they're not adding as many points. And you've also got to remember, you've got to sort of back out some of the oil stocks as well. So Total is down today here in Europe. Shell is down by 0.3%. So kind of one factor maybe compensating for the other. It's interesting, you've got Astra up, GSK down, you've got the miners up, but you've got the commodities on the oil side down as well. Much more balanced kind of read in terms of what we're seeing in this market today. Maybe more normal is the way of describing it.
Right, so that's what we see across equity markets this morning. Of course, we've seen some strength in equity markets in recent months, and the tech sector was back to the fore yesterday. That hasn't necessarily been matched by a strength in IPOs, by new companies coming to the market. We got some thoughts on that from the JP Morgan CEO, Jamie Dimon, who told Bloomberg exclusively how regulators in the US and UK need to make it easier for companies to go public.
I think it may very well stay muted because markets may come down as opposed to just go up endlessly, and they may find other sources. So when I speak to a lot of private equity and private venture and stuff like that, they tell you they have more non-public sources. I do think it's very important that our policymakers understand, because even here in the United States, we've made it hard to go public.
That's the JP Morgan CEO, Jamie Dimon, speaking to our colleague Lisa Abramowitz, exclusively speaking to Bloomberg, in fact. Let's go to another part of JP Morgan. Eric Witness joins us, EMEA Investment Strategy Head of JP Morgan Private Bank. Very nice to have you with us today. Thank you for coming to speak to us, Eric. So that's the conversation around IPOs. We'll park that for just a moment, thinking about the listed universe as it is right now. The earnings story is going to be front and centre before we know it. Come Friday, we're going to be talking about the banking sector and then on to the weeks ahead. What are you going to be... I mean, always we're looking for outlook statements and guidance from corporates, but is there anything specific that you're homing in on as we approach this earnings story?
The continued health or buoyancy of the consumer, we think, is going to be very important for the forthcoming earnings season that, as you mentioned, kicks off on Friday, and we'll have a lot more information in the subsequent weeks and months to come. Earnings tend to be the main driver of equity prices over the long run. We've had a heck of a rally in overall risk assets in the U.S. so far year to date, but in a market that's now trading north of 21.5 times from a forward PE ratio, it's probably going to take another strong earnings season for that next phase of the rally.
And is there a sort of tax threat hanging over European corporates at the moment? I'm thinking here about the number of governments in Europe that, they're looking at weak balance sheets, looking at corporates with what some describe to us as relatively strong balance sheets and thinking, how do governments rebuild the coffers? Maybe we need to tax companies a little more. How are you thinking about that? How is that priced into the earnings story we're going to hear about?
I think as we more so get into 2025, we get through some of these large events that are occurring around the world, debt to GDP ratios, government policies, government balance sheets, they're probably going to be more a part of the main market narrative, I think, next year. One of the things that comes to mind for me here is Mario Draghi's recent European competitiveness report. I thought that was a very interesting diagnosis with suggestions about investing to a greater degree and also trying to lighten up the degree of bureaucratic overhang to try to help foster investment, entrepreneurship, and ideally economic growth.
The problem with that is it's theoretical. The Americans are doing it. What is the reason how strong are the reasons right now not to put money to work in the United States? If I've got an extra euro, dollar, pound, whatever it is, why shouldn't I be putting it to work in America?
The U.S. exceptionalism argument, so to speak. I would agree with you. It is a little bit hard to go against. The innovation, the FCF, the free cash flow generation of the companies in the U.S., the GDP growth that has been so remarkably sustainable. You know, resilient is a word that we use a lot to describe the health of the U.S. economy. I hear you. It's difficult to argue against, and we actually do continue to have a preference for the USA.
How big a threat to that is the election?
Markets tend to actually look through geopolitical events, however large, disruptive they might be. Over the long run, the impact of all these things on markets genuinely does tend to be temporary. And as we look forward over a medium-term type of time horizon, it's most likely to be the health of companies, plain old-fashioned earnings, what the consumer does, and the growth of the economy that will dictate things.
How big could the volatility be, though, around that election? Like, what are you telling clients? What are clients asking you? It seems to be the #1 subject that everybody's asking about at the moment. You're telling them to look through it.
Well, we more so kind of ground ourselves where we are year to date, which is approximately up about 20%. What those valuation levels are. The fact that volatility is actually fairly subdued given all these things that are occurring in the world. Last time I was with you all, it was in early August, right around the time of that large yen carry trade unwind movement. We had that dramatic spike in the VIX. So things can move quickly, time to time, from a volatility standpoint. So if we were to see anything even slightly resembling that, we might view it as a bit of an opportunity to phase in for long-term investment portfolios.
And Eric, are you so confident in the resilience of the US economy that you're in the no landing camp?
So we categorize ourselves as in the soft landing camp, but it is definitely a constructive development just over the last few days that we sort of saw this triple whammy of quite encouraging data in the U.S. We had that kind of gangbusters, non-farm payrolls print meaningfully ahead of expectations. The decline in the unemployment rate, which was actually close to going all the way down to 4.0% due to rounding. So the 4.2 to 4.1 move was very encouraging, but it actually could have been even better. And then what seemed to be almost entirely overlooked due to the focus on the jobs market, the services ISM figure was also a substantial upside surprise. So there's a good combination in a Goldilocks-ish type of scenario for the U.S. at the moment.
OK, and I also want to ask you about the growth outlook here in the UK, because we've got a budget coming. You deal a lot with ultra-wealthy families. Have they got their bags at the door expecting tax hikes and a fiscal tightening?
No doubt there will be a tremendous amount of focus, analysis, and a close look at every detail in that budget that comes later in the month. It's going to be important. I think you mentioned one of the key focus points, which is tax. We'll have a lot of analysis on that as the details come forth. But for sure, it's a bit of a factor for how people think about where do they want to invest, where do they want to, you know, kind of pay their tax dollar and what the upcoming regime might look like.
We'll watch to see if we do get any of that shift then. What about other assets that we don't maybe cover so often, Eric, in our conversations? And infrastructure stands out to me. Private infrastructure is one area that you favour. What is it that discerns the projects that you want to get involved with from those that don't? What are you looking for specifically?
So the need for countries to invest in this space, oftentimes in conjunction with the private sector. There's so much modernization and upkeep of major infrastructure projects all around the world that needs to take place. There's so-called static infrastructure, ports, bridges, roads. There's so-called moving infrastructure, shipping lanes, shipping routes, contracted, consistent flow of goods around the world in a lot of these different investment opportunities. We think it makes a lot of sense, particularly in 25 and beyond, as there's probably going to be, in our expectation, a greater focus on these debt-to-GDP ratios and a desire for strategies that are less correlated to traditional asset classes. And to us, private infrastructure strategies, very much so, fit the bill for that.
In terms of kind of how you're thinking about where you look at the long-term story and it being, infrastructure is one. You think the US probably looks like a fairly good long-term bet. You're not worried about the short-term volatility around the election. What about China? Have we reached a point where China has become investable? How many calls are you getting saying What's the China position right now? Should we be increasing the China position? Have we been too underweight? Are we too underweight China? Kind of what does the picture look like from an investor question point of view in terms of kind of how you're thinking about it?
For sure, to your point, the market has seemed very underweight and underinvested in China recently. There has been certainly a bit of a bearish sentiment overhang. Positioning has been light. Technicals have not been great. Valuations have been cheap, so that should suggest an attractiveness from an investment standpoint. It seems as though it's largely going to come down to how continual is the support from the Chinese authorities, mainly on the fiscal front, to try to stimulate the economy. One of the things I was looking at just yesterday in preparation for our chat here today was the magnitude of stimulus that the U.S. did, for example, during COVID times. It was absolutely enormous, well north of $4 trillion in total. If China wants to stimulate the actual economy in addition to the market, it's probably going to need to show the marketplace that it's going to be fairly aggressive.
So this is the stimulus they never did and should have done but didn't do and is now coming late. Is that how we should think about it?
The way I would categorize it is it's been shown for quite some time since the GFC that the countries and the economies that invest for the future and are aggressive in doing so can help point things in a positive direction. It increases debt. But that is the type of movement and directionality the market's hoping for from China.
Nice to see you, Eric. Thanks for stopping by to see us. Eric White-Innes, EMEA Investment Strategy Head at JP Morgan Private Bank. Let's take a look at the Core 6, figure out what is happening at the centre of Europe. This is the story that we're watching this morning. A little more negative than positive. Ferrari's up a little bit. Novo Nordisk is up a little bit. These are not big gains, but they're also not big drops to the downside either. TSMC numbers out overnight. ASML is down by 0.8%. Keep an eye on the Google story, though. That could have an impact on the session a little bit later on, Anna.
Let's have a think about some of the stocks that are on the move this morning. For the individual movers, here's Joe Easton. Joe.
So we are now seeing some positive trading in Continental and are gaining around 3% at the open of trading in Germany. Remember, we had a pre-close call with analysts ahead of their third quarter report. That was last night, and analysts over at Jefferies, Bernstein, all giving a positive take, saying that given there was no further cut to guidance, that is a bit of a relief for the parts maker that had a profit warning just around 3 weeks ago. Then we'll check in on Kering. That one was also seeing a bit of a boost on the back of a new CEO at that business in terms of the Gucci CEO coming in, stepping up from deputy CEO. But actually not too much of a gain at the moment, up 0.2%. Pretty steady in terms of most of the luxury stocks this morning following the declines we saw yesterday. Though LVMH down 0.8%. Again, a bit of weakness coming through into that one today. Then in terms of pharmaceuticals, Zealand Pharma, one of the best performing stocks in Europe this year, given their exposure to obesity drugs. They got a letter from the FDA last night relating to one of their diabetes drugs, and analysts say that could mean a delay to that product getting approved. So we are seeing that one declining around 4% over in Copenhagen. Then in terms of the Boeing read across, we were looking at Airbus, not too much. As Guy mentioned there, we might get a delivery update on that one later. Then we are also seeing Safran coming down slightly, senior edging higher. Remember, this is related to the strikes continuing on the US West Coast at the Boeing plants. Then in terms of your morning calls, mentioned BP, that one is slipping, but with the broader market actually recovered very slightly. Exane has been buy rated on that for 3 years, but bring it down to neutral given oversupply from OPEC, according to them. Then we've got Delivery Hero looking to spin off their Middle Eastern unit, and that spurs an upgrade over at Stifel. That one up to buy. Little movement in that one, very slightly higher. And finally, WPP, after it won the contract once again for Unilever's main ad business, this spurs an upgrade for the stock over at Citi. They put it on a catalyst watch, positive catalyst watch, maintaining the buy rating, and that one is rising at 1% in London today.
All right, Joe Easton from our equities team, we thank you. You mentioned Boeing and the read across to Airbus, or lack thereof, and we're going to dive deeper into that Boeing story next. Talks with its largest union collapsing for the third time. We'll bring you all the details next. This is Bloomberg.
OK, welcome back. This is what the opening trade looks like here in Europe. As you can see, a fairly mixed picture. I can't clearly sort of come up with a narrative to fit the price action this morning. There seem to be so many moving parts that we're watching. We're watching what's happening in China. We're looking at the Fed minutes a little bit later on. We've got data coming out of the States tomorrow. The CPI print is going to be important. And then, of course, you've got what is happening on the single stock story front. And at the top of that list is what is happening potentially with Google. The US is weighing what could be a historic breakup of Google. This is a remedy potentially in a monopoly case, one of a number of monopoly cases that is being pursued by the DOJ. The DOJ is looking at forcing Google potentially to sell off parts of its operations. It's seeking to prevent it using products including Chrome, including Android, to its advantage. It's one of the more dramatic remedies being proposed. But there's a number of different cases that we are talking about here. Bloomberg's executive editor for Asia Technology, Peter Elstrom, is in London. It's fantastic for him to join us around the table this morning. How seriously should we take this threat of a breakup of Google?
I think this is a very serious option for the Justice Department. We are in early stages of this case. Of course, we had the judge in this case, Amit Mehta, decide in August that, in fact, Google is a monopoly. It has been abusing its monopoly power in search in particular. So now the Justice Department is coming forward with some very dramatic potential remedies to this. 32-page document that lays out, as you say, a possible breakup of Google, the separation of certain operations, but also some behavioral changes that would be pretty significant for its business. As you mentioned, right now, they have a very significant presence in Chrome, in particular, the browser. They can use that to direct people into their search business. Yeah. They also have the Android operating system that helps them. So there are many options here. The breakup is perhaps the most radical, but there are some others that would be pretty important for their business, too.
So how dramatic could this be? We've already had some early response from Google, which was, I mean, probably not designed to be funny, but they said if you break us up, this will break us. I'm not quite sure what we're supposed to make of that statement.
Google, of course, objected to these proposals from the Justice Department. They talked about this as radical. They said that there's going to be unintended consequences. They talk about how consumers benefit from some of these integrations of their services in particular. But it is significant. Right now, the judge is only getting these proposals. We're going to have a trial next year, and then ultimately the Judge Mehta is going to make a decision later on next year, roughly August or so.
I'm trying to contextualize how significant this is. You know, we were talking about the Microsoft experience 20 years ago, unsuccessful as it was, and then we think about if you have J.D. Vance making VP, are you going to expect more of the same? And is this so much more significant than what we've seen before?
You're exactly right. There's some surprising alignment here between what the Democrats and the Republicans are saying. J.D. Vance, in particular, has called out big tech for their power. And to be clear, this is part of a much broader effort by the current administration to go after big tech. It's not just Google, it's Amazon, it's Apple, it's Meta also. They're even going after NVIDIA, which has really established its dominance very, very recently in the AI chip sector. So this is a serious signal. The Justice Department and the FTC have had some defeats in their efforts to kind of push back on big tech, but this is a sign of progress in what they're trying to accomplish.
Peter, I want to bring up a chart of Google's market cap and think about value within this business. If you break it up into the sum of its parts, could it be worth more?
Yeah, this is Bloomberg after all. Yeah, this is one of the key questions. There's a very good chance that if Google was broken up into different pieces, there would be a lot of value there. They, of course, have many different businesses. Search is sort of the gold mine at this point. It's always been their most powerful business. But they have many other potential businesses that could end up being quite valuable beyond that. The Android app operating system they haven't really capitalized on. They're investing a lot of money in AI. We see what's happening with OpenAI and what the valuations are there. Yeah. If Google were to spin off its AI business, what would that actually be worth too? So if you're playing the market here, I think you make a good point.
My memory goes back to trips to Brussels, early 2000s, was it? Mid 2000s, to talk about Microsoft and attempts to stop it making use of its position to push people towards its other products. I think it was a media player at the time that all the fuss was about. Are thoughts about Microsoft and any read across useful here?
Yeah, well, certainly the last very big antitrust investigation into big tech was Microsoft. I think in that case, they were also talking about a breakup, as I'm sure you'll recall. That probably would have made the company more valuable at the time. But in the end, they did deter Microsoft from making some acquisitions and making some expansions that they had. Europe, of course, led a bunch of that charge at the time. But I think in the end, Microsoft did stay together. The operating system was not broken out. Office was not broken out. So you ended up having the company kind of remain coherent. In Google, that's certainly a possibility here, but this effort will probably deter them from doing some things that they otherwise would like to do.
OK, so where the Microsoft threat kind of changed its behaviour, is the threat of the breakup enough to get Google to change here?
I think we're already seeing that. I think Google has been deterred from making some of the more aggressive moves. And there's some speculation also that even in the AI field, they were playing it kind of careful as they were expanding in AI. They let OpenAI and ChatGPT get ahead of them in many ways. And I think there are areas we see Google maybe was pulling back from things that otherwise would have done if they didn't have this threat of an antitrust investigation hanging over their head, not just in search, of course, but in other areas too.
Peter, great to see you around the table. Thank you very much indeed for joining us. Peter Elstrom. Let's talk about what is happening with Boeing. The company has broken off talks with the unions. The strike is ongoing. How long will it last? A key question, particularly for the rating agencies who are watching this company like a hawk. Benedict Campbell joins us now on this subject. Benny, let's talk about why talks are broken down first.
Both sides basically blaming one another, saying Boeing saying that they were met with demands from the unions that they couldn't meet. They said we have to preserve the viability of the company, and going as far as the union would like us to, that would basically break that. The unions, on the other hand, saying that Boeing isn't budging on its previous offer. That was an offer that was made 2 weeks ago. And it called for about a 30% increase in wages and a couple of other benefits. Interestingly, that was an offer that they took directly to workers, so they sort of tried to break the impasse by going directly to the workers. That didn't go down well with the unions, and then late yesterday, after only 2 days of talks, they broke down again. So it's really unclear where they go from here and how they might be able to pick it up again.
Well, obviously, a downgrade would cost them more for borrowing if S&P goes through with it. How much more would it cost them? I'm trying to think of where the downward spiral stops, where the hope could come from for Boeing, Benny.
Well, the credit rating is sort of a key metric for Boeing, and the CFO, Brian West, he has said that they are really keen to preserve this. We reported last week that one step they are considering is raising a considerable cash, maybe via equity, something north of $10 billion, but that's probably the floor of what they need at this point. And even then, it's unclear whether a measure as dramatic as that would even help them. So all rating agencies, S&P, Moody's, and Fitch, have them on the cusp of junk. So they're just a very small step away from that ledge. And the longer the strike takes and the more it costs, Benny? The harder it will be for Boeing to keep it going.
Thank you very much. Thanks to Bloomberg's Benedict Campbell. Thanks for the coverage, of course, of the aviation sector. We will come back to talk more about China and its fiscal policy. This is Bloomberg. This is the opening trade. Welcome back to the programme. 30 minutes into our European session. Not making huge headway to the upside or the downside, for that matter, on stocks. Up by around 0.1%. A pretty mixed picture across different geographies. US futures point a little bit lower. Perhaps Google weighing on Nasdaq futures. That market down by 0.4% right now. Here in Europe, then, things are broadly slightly positive. Let's get a perspective on the global economy. Billionaire investor Ray Dalio does not anticipate that the Federal Reserve will make significant cuts in rates after policymakers slashed rates by 0.5 percentage point. The Bridgewater Associates founder spoke at the Greenwich Economic Forum.
First of all, I don't think you're going to get significant cuts in rates. I think the economy, by and large, right now itself, is in relatively good balance. So if you look at where growth is, where inflation is, and so on right now, and you have a political year, I think the markets are getting ahead of themselves with expecting that, and I think the risks are more on the upside than the downside.
Let's get another perspective. Mark Dowding, CIO at RBC Blue Bay Fixed Income, joins us. Mark, very nice to have you with us. So he sees risks to the upside rather than the downside, talking there about the global economy on balance, although hard to call. I mean, hard to call seems to be the message we get from a lot of people right now.
So I think it really is, and I think it depends partly on your time horizon, because 12 months out, there seems to be a lot of uncertainty in terms of where we'll be. But I would be inclined to agree with Ray over the course of the next few months. If anything, it looks like economic data has been on an accelerating trend. And actually, with the Fed doing 50, it seems in the short term, recession risk is very low right now. It's maybe more of an issue later next year, perhaps.
So when looking out only a month, you get to the US election, of course. Do you manage to put that aside when it comes to investment strategy? I mean, this is a huge thing to look through, and yet some investors tell us, you know, we put it to one side because we expected divided Washington, or others have other reasons to do so. But how do you treat that as such a big unknown in your strategy right now?
Yeah, so I don't think you can simply run with an idea that you're going to ignore what is one of the big events of the year just ahead of us on November 5th, right? I think the way that we would be looking at this, markets would be looking at this, is if you end up with Trump winning, which, if you put a gun to my head, I'd say is slightly the more likely outcome right now, given how Dems have tended to bleed support during November and October in prior election campaigns. In that scenario, if you did see the Republicans taking the sweep, we would see that that would be a more inflationary outcome for markets. It would also be an outcome that could actually sort of see equities in the short term doing a little bit better. You'd also see the dollar moving stronger on the back of that. So I think that there are very different outcomes depending on the eventual sort of election conclusion here.
So what do you do with that? Turn that into an investment?
So I think you try and focus on the ideas that you think are the most obvious to you. I mean, one of the things that strikes me is almost regardless of who wins this election, the narrative is going to be continual easy fiscal policy in the United States. There's no desire to address the debt level in the States, and it feels like policymakers have come up with this genius idea that everyone wants to pay less in tax. And so
is that a steep
why don't
curve?
you keep
so
going?
Presumably that means...
Exactly.
Short rates down, long rates up.
Exactly. I think that eventually you end up needing more term premium in the US curve. So structurally, I think you can have confidence in curve steepening trades as an idea. So that would be something that I think that you do want to position for in the here and now. Otherwise, I'd say that in the short term, one of the things that strikes me is that in areas of risk assets, including in credit, there's been quite a lot of caution over the course of the last number of months around a potential economic slowdown, because the data in the short term looks pretty good, because I think a lot of other investors are underinvested at this point in time. I wouldn't be surprised for credit spreads to continue to squeeze tighter over the course of the coming weeks.
So if you think that Trump's inflationary, how soon do you think that the Fed would get back to hiking if he wins?
Well, I think that's a great question to be asking. And one of the things that we've reflected on in the past is how the current economic cycle that we're looking at in the here and now may actually have many more parallels to what we saw in the 1990s. And here there were a couple of episodes where the Fed started cutting interest rates in response to slowing growth, and rates only came down by 50 or 75 basis points before they went back the other way. So I wouldn't rule out at all the idea that we get one or two more cuts from the Fed. But if we do see an overtly more inflationary Trump with policies on tariffs, policies clamping down on immigration that tighten the labour market and all, and delivering further fiscal stimulus, who's not to say that in the middle of next year we could be talking about a Fed hike, not a Fed cut? It's all within the realms of possibility.
And what about monetary policy uncertainty here in the UK? You've had the Bank of England Governor Andrew Bailey saying maybe we could get more aggressive cuts, and then the chief economist Hugh Pill kind of pulling in the other direction. Where does it leave the pound? Has it seen its best days?
So I'm sure the Bank of England would really like to cut rates. It would really like to be in a position to lower rates. But the problem ultimately is I think that inflation is a bit more sticky here in the UK than we're seeing in some other major economies, largely because if you look at service price inflation, it's still tracking around 5.5%. And in an economy that doesn't have a lot of productivity growth, whenever we see wage gains, that just feeds back into inflationary pressure. So although headline inflation has dipped low over the last couple of months, we're expecting headline inflation to pick up. And it's going to be difficult for the bank to actually lower rates by very much, we think, over the course of coming quarters in light of that. And I think that the problem that the UK faces is there's not really a lot of scope, in my mind, to ease monetary policy, nor is there much scope to ease fiscal policy either. So it just looks like a fairly uninspiring growth backdrop.
OK, even though the word is growth, 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 they keep saying it, they keep talking about it. With all of that in mind, and if you think that's what the gilt markets are focused on then, this sort of sticky inflation, lack of rate cuts in the UK relative to other places, so how do you play gilts then around the budget? Because this is going to get a lot of attention given budgets and other fiscal events that have substantially moved fixed income markets.
Yeah, so from my point of view, I mean, you look at cash at 475 and you'd say that actually cash still looks more attractive than a lot of gilt yields at the current point in time. Gilts have been underperforming other markets, so they'll move with the beta of what's going on elsewhere globally. But thematically, I think it's difficult to get too bullish around UK fixed income as an asset class right here, right now. When yield curves are inverted, even when we're talking about rate cuts, you're still having to fight the forwards, and we're still in a world where cash is the high yield.
But you don't sound too concerned about, from a sort of bond market volatility perspective, by what might be announced at the end of this month.
So I think potentially concerned, yes, depending on what we hear. I think that in the UK we have it in our psyche what we saw back in 22 with Liz Truss and with Rachel Reeves looking like she's seeking to amend the OBR framework. Potentially that could create a lot of fiscal space which would actually pertain to a lot of additional supply. So I do think that she's walking a bit of a tightrope here. I actually think that she's a very smart operator. I wouldn't put her in the camp of Truss and Kwarteng. I think she does have a good handle on what she's doing, but I think it's very difficult for Labour here because their popularity rating has plummeted in a fashion that is rarely seen in terms of a new government. I mean, the approval rating for Paul Keir Starmer has gone off a cliff. So I'm sure there's some desperation to deliver some of Labour's manifesto agenda and go for growth and go for investment. But at the moment, we have to be very careful because there's just not that much space.
So about Japan. What is going on? Shiba comes through, he says, I don't want the BOJ to make a significant move in terms of the hikes. Is that tactical because he's worried about the election coming up? Is that because he wants a weak yen going into a Trump victory potentially? Do you think that really is the reflection? I'm looking at the data that came out yesterday. Base salaries rise by a record in a positive sign. What do you think happens after the US election and after the Japanese election with the BOJ?
Yeah. So here I would say that, I mean, Ishiba is a relatively inexperienced political operator.
Yeah.
He doesn't have a big support base within the LDP party itself. And, of course, he's going to be sort of very focused on the elections that have been called come the end of the month. If he loses a lot of seats in this election, he may end up being out of his ear in the space of a couple of months.
Right.
So he really may not last. So that's his near-term focus. So he would like the equity market to go stronger into the election later in the month. So I think that's his focus. We've always thought, in sort of dialogue with policymakers in Japan, that with an election taking place, the BOJ is effectively off the table in terms of interest rates in October, and it's more a question for December or January. We've always thought a January hike is more likely because that's a quarterly BOJ meeting where they'll be updating their forecasts. But the one interesting thing about October that hasn't been spoken about much at this particular point is that one of the topics being assessed, I think, by the BOJ is could they leave interest rates where they are but actually look to tweak their BOJ purchase schedule and their exit from very stimulative QE policies. In many ways, it's remarkable. Japan had this thing, yield curve control, and many of us were very scared that any attempt to exit this would be very messy. And they've done a very good job. Yields have gone down, not up. And so that could actually speak to them having an ability to actually go a bit faster in reducing their BOJ bond purchases. So the Rinban schedule will be the thing we're looking for at the BOJ at the end of the month.
Be interesting to see what impact that would have on global liquidity. Nice to see you, Mark.
Thank you.
Thanks for stopping by. Mark Downey,
Thank you.
CIO at RBC Blue Bay Fixed Income. Thank you very much indeed for joining us. Coming up, got a few problems over at Perrier, why one of the world's best-known mineral waters has put the water industry firmly in the spotlight. More on that story next. This is Bloomberg.
Welcome back to the opening trade. We are nearly 45 minutes into today's session. Stock 600 higher, nearly 0.2%. The FTSE 100 doing better, 0.4% higher. We're digesting the announcement of an announcement from China on the fiscal picture on Saturday. But let's take you to our big take now. As the global water business grapples with questions of sustainability, one of the world's most famous brands is facing increasing challenges. Perrier suspended production and destroyed 2 million bottles in April on worries about contamination. The story is the subject of today's Big Take, and here with us with the details is Bloomberg's Dasha Afanasieva. Dasha, this is making me parched just talking about water. What's Perrier and Nestle doing about these problems?
So it's not that Perrier has suspended production. It suspended one of its wells when it was found to have contaminants, fecal contaminants. And apart from that, it's come up with some longer-term solutions, which is to overhaul its production, to modernise. They've invested around 150 million euros to get things going so that you're sort of cleaning through the pipes and you don't have contaminants involved. They're also encouraging organic farming rather than pesticide farming. That's been the case for a long time. That's all on the good side of what they've been doing. I think kind of on the bad side is that in 2020, when they realised internally they had a change in management, they realised that Perrier was being cleaned using illegal methods, charcoal and UV filtering. They're illegal for mineral water because it's supposed to be almost untouched. They didn't tell the public. They kind of, behind the scenes, negotiated with regulators and did all of the stuff behind the scenes. And earlier this year, it all kind of came to the fore in a leaked report.
What does this mean for Nestle? What is Nestle doing about it? Nestle is the owner.
Nestle is the owner, and its water business, even Perrier plus some other brands, isn't a huge proportion of its sales. It's only about 3.5%. So it's not huge in that sense, but I think it's a reputational issue because Nestle's had its problems with reputation. We had the infant formula scandal that started in the 1970s. More recently, there were really tragic cases in France of E. coli contamination in a frozen pizza. So for Nestle, it's about how do we get the trust back of consumers. And we know that Mark Schneider, the former CEO, was ousted in August. So some might look at this and say, there are operational execution issues at Nestle.
And what about the sustainability of the water business overall? I mean, as people think about sustainability more and trying to use bottled water less in some areas, is this seen as a growth category?
Yes, it's a really big growth category because it's seen as a healthy drink. It's definitely better than sugary sodas. But reporting on this question came up time and time again, particularly if you're in France and you're having to filter water because, of contaminants and because of particularly climate change making those worse because you either have droughts or you have torrential rain. And then you're sending that water to the other side of the globe. They've had this product called Maison Perrier, which makes no secret of filtering because it's not a mineral product. And you sort of wonder, should all that water be packaged up in plastic that can sometimes leach into the water and get all these carbon miles being sent to the other side of the world? And I think that's the fundamental question and an existential threat, perhaps, for the industry as a whole.
Dasha, thank you very much. Thanks for bringing us the story. Dasha Afanasieva with the latest on Nestle, on Perrier. Really interesting story on the Bloomberg terminal and on the website. Let's focus back on some of the items on our trading agenda today. We have some data out of the United States in terms of mortgages. We have inflation data from Mexico, from Brazil. Crucially, we get Fed minutes a little bit later on. And from a UK perspective, here in Europe, we're going to be seeing the UK Chancellor Rachel Reeves meeting bank chiefs from Barclays, HSBC, Lloyds, NatWest, Santander, etc. So that's going to be one focus on the UK.
What do you think that conversation's going to look like? what are they going to be asking for? It feels like we're into the final stages of budget planning. Is this about them going in there and saying, can you just put a more positive spin on it, or is it about them going in there and saying, please don't raise taxes? You do wonder which side of the coin they're ultimately going to be coming down on.
Well, think about what Kit and Eric have said to us. It sounds like what people want is just for her to sound credible. Don't sound like you've drafted this on the back of a fag packet. You know, I was thinking about her credentials. There's a lot of talk about how Rachel Reeves is an ex-Bank of England economist. Someone pointed out to me that she has as much experience at the Bank of England as Matt Hancock, the former Conservative minister. You have been looking at her CV, Guy.
I have. Yeah, there's plenty of fact-checking going on. The real... I'm not sure the Bank of England stuff, how relevant it is. Does it mean that she can run the economy better? I don't know. Yes or no. It's about sentiment at this point, though, isn't it? It's about how this economy is actually performing. In some ways, they have inherited quite a decent economy.
Exactly.
And I'm wondering whether or not, actually, what they're doing at the moment is detracting from that. And maybe that's the message the bankers bring, which is get on the front foot, sound positive. Is there a message to them coming in here and saying, actually, here are some positive things that you can do? I'd be fascinated to see what the tone is, given the fact that this is an economy that should be doing better than maybe the data suggests that it is.
The way to do that is, in my view, to separate the fiscal outlook from the economic outlook. And the fact that they've been lumping the two together as doomy and gloomy over the summer is where the problems have laid.
Well, we'll see how this... We've got the investment summit, then we've got the budget, lots of occasions to zoom in on the UK. Let's think about something else on our agenda. We mentioned as we were just going through the trading day that we'll get Fed minutes. So let's bring in our colleague Valerie Teitel, who, of course, is never far away from any Fed conversation. And she's here on set with us this morning. Val, so we've been thinking about Fed minutes, and, you know, you could say this is going to give us a huge amount of insight into how much consensus there was around 50 basis points in that cut, or how much Powell was out on his own. But will we really get that from the minutes? What are you expecting?
Yes, the minutes are going to show that there was some debate around the 50 or 25. We know that for sure. That was obvious in the dot plot that came out in their projections. But, you know, I think there's a risk of these minutes sounding hawkish to the market. Because remember, this meeting happened, you know, before those revisions to GDI that showed personal spending coming down, before the hot payroll report. So there probably was an attitude from the Fed that we wanted to not let the market get ahead of itself on a possible string of 50s to come. We want to pair them back again and somehow, you know, send the message in the minutes that it was very much a close call.
But the payrolls have already positioned us for that, haven't they? How hawkish are they going to be? If you didn't have the payroll number, they would sound hawkish. But you plug the payroll number in, the market's moved quite significantly already.
Yeah.
Are we already positioned for a more hawkish-sounding set of minutes?
Yes, that's very possible, Guy. But, you know, the recent Fed speak that we have had has always talked about this balance between inflation and unemployment. Everything seems a bit more balanced now. Now, we do get CPI tomorrow, and you know, the risks to the upside of inflation. You know, Jamie Dimon was talking about the possible upside risks to inflation that are on his mind, but you know, we haven't heard that from the Fed members, and I think we're a bit far away from hearing that from Fed members directly. We're going to need a string of 0.3 month-on-month CPI prints in order to tempt the Fed.
How likely is that?
Well, at the moment, the estimations for tomorrow's month-on-month print is 0.1. So we would probably need, you know, at least two back-to-back 0.3 CPI prints, because a 0.3 would take us farther away from this 2% goal of the Fed. So, you know, that could be, you know, the next story to come, but I think we're a bit far away from pricing in, you know, a pause or a skip. Let's say.
Yeah, Jamie Dimon's saying that he is still cautious on inflation, but the Fed right to cut by that 50 basis points last month. I do wonder how many of them are in the regretful feeling about going for that jumbo hike. But as you say, really, it's more about CPI, surely, than the Fed minutes tonight.
Well, CPI tomorrow, you know, it's going to catch a lot of people's eye as well. That, you know, the Fed minutes, yes, they are reflexive, but, you know, knowing a bit more about what went into their thought process is going to guide us maybe if we get more data to come that comes a bit weak, right? You know, how many hot data prints do we have to see in order to see a change of language from the Fed? That's definitely going to be on our mind, and with CPI this week, that's one of them.
It was a really weird run-up to that last Fed meeting when we saw that, you know, the market thought it was going to be 25. They were in the blackout period. And then we got these comments in the Wall Street Journal, or this story that looked on one level kind of balanced, but was certainly making the case that we could see 50. And the market started to say, OK, we see what's going on here. I wonder if we get any sense of that backstory coming through in the minutes.
Yeah, the drama that was before the meeting, always looking out for some leak about what they're possibly going to decide. But, you know, I think the Fed speak to come is still going to be on a narrative that the Fed is cutting. You know, the Fed put is still there, that they would maybe look through a string of hot prints and still talk about risk being balanced, cutting to come. And I do think that's going to push equity markets, tempt equity markets back up to all-time highs. This is a really positive outlook for risk. Generally, we have the Fed easing and we have the U.S. economy, you know, on a good path. You were mentioning the Atlanta GDP Fed now, you know, it's still 3.2%.
We've got a hurricane coming and we've got an election coming. I'm just wondering if the market is looking at the wrong thing right now. This all feels sort of fairly rear-view mirror. The data on CPI is going to be fairly rear-view mirror. What is the potential for the kind of where we are now positioning to be upset by some of these other factors? How vulnerable is the market at the moment in terms of its setup?
Well, you could think about the hurricane in a way that we won't necessarily get a clean jobs print for a few months now. And, you know, given the labor market was of a focus for the Fed, that would be the thing to tempt them to cut more aggressively. You know, that could make for some choppy markets into the end of the year, possibly.
Absolutely. And the election, the big election, everybody seems to be discounting it and saying we can just look through it. And actually, we're going to get divided government, and as a result of which, it's not going to be a factor. Valerie, thank you very much indeed. Valerie Teitel. We are going to be looking forward to that. That's going to be one of the themes that we're going to be watching. This time tomorrow, Milton will have made landfall.
Yes, exactly. And so with trepidation, we look ahead to that. You know, we'll watch from a market perspective, looking at cat bonds, looking at citrus prices, of course, but from an everyday disruption perspective to businesses in Florida, this is going to be huge. We've seen theme parks closing. I know SpaceX had to delay one of their launches. We could be dealing with power outages. An emergency situation called in 51 counties.
But it's a major metropolitan area, and that's the difference this time around. LN caused widespread damage. This could hit a major metropolitan area, and we haven't seen... Tampa hasn't been hit for 100 years.
Yeah, home to a big port. The biggest port in Florida, actually, a major US military base. JP Morgan's got 6,000 people in its office there. It's significant.
And as we were hearing from our colleague Mary earlier on, how wide the winds, the strong winds go is going to be a real deciding factor as to how widespread that damage is, and in terms of how widespread the storm surge is as well, because that seems to be something that, from an insurance perspective, we're watching very closely. That is it for this hour of the programme. Plenty more coming up. Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle, will be joining the Pulse. That's in around 30 minutes' time. Lots to discuss there. Oil prices 77.78 on Brent, up by 0.8% this hour. That is it for the opening trade. The Pulse is up next. This is Bloomberg.